As cryptocurrency becomes more popular, we're starting to see signs that it could become part of our financial future.
All right, let's talk about crypto. You've heard the stories. People striking it rich overnight, quitting their jobs, splurging on Lamborghinis. But here's the reality check. In 2025, an estimated 99% of crypto buyers are expected to lose money. And while these numbers can always be debated, a recent study by Barron's found that 75% of Bitcoin investors had already taken a loss. So if you're thinking about getting in, you might want to rethink your strategy. Crypto has been around for over a decade now, and while it has made some people very rich, the truth is that most people lose. And they don't just lose small amounts, they lose big. Why? Because the market is extremely volatile, unpredictable, and full of risks that many people don't fully understand. First, let's talk about why crypto is so attractive. Bitcoin, Ethereum, NFTs, DeFi, smart contracts, these buzzwords make it sound like a financial revolution, and to be fair, blockchain technology is groundbreaking. Crypto is marketed as the future of money, a decentralized alternative to banks and governments, and people love the idea of getting in early before mass adoption. Every time a new project goes viral, a flood of new investors rushes in, hoping to ride the next wave. They hear about 100x gains, life-changing wealth, and passive income from staking. It's an intoxicating mix of technology, exclusivity, and FOMO. But the problem is, the most people aren't prepared for the reality of crypto. They see others making money and assume they can do the same. They believe it's as simple as buying a coin, holding on to it, and waiting for the price to skyrocket. But that's rarely how it works. One of the biggest reasons people lose money in crypto? They don't fully understand what they're investing in. They see someone on Twitter hyping up a coin or a YouTuber claiming it's the next big thing, and they jump in blindly. But without real research, they make huge mistakes, buying at the wrong time, falling for scams, or misjudging risk. Here's the reality. Crypto is one of the most unpredictable markets in existence. Unlike stocks and bonds, which have historical performance data and government oversight, crypto is a roller coaster with no safety net. Prices can double overnight, or crash just as fast. And the reasons? Speculation, hype, and outright manipulation. Take Bitcoin. In 2021, it soared to over $60,000, then plummeted to nearly half that value in months. And it's not just Bitcoin. The entire crypto market reacts to social media, celebrity tweets, and news cycles. Elon Musk can post a single tweet and send a coin soaring or crashing. It's not just about supply and demand, it's about emotion. And the worst part? Many investors don't understand how these price movements work. They just assume that just because a coin is going up, it will keep going up. They don't realize that corrections are inevitable, and when they do happen, they can be devastating. One of the biggest mistakes investors make, letting fear of missing out, or FOMO, lead them to buy at the worst possible time, usually at the top of a rally. This is called buying the top. Prices are at their highest, everyone is hyped up, and people think, if I don't get in now, I'll miss my chance. But the market inevitably corrects, and when it does, panic sets in. Investors either sell at a loss or hold on, hoping things turn around, and for most, they never do. And this cycle repeats over and over again. People get in when prices are high, panic when they drop, and sell at a loss. Then they wait until the next hype cycle only to make the same mistake all over again. A great example is the Dogecoin hype of 2021. It started as a joke, but thanks to social media and celebrity endorsements, it skyrocketed. Thousands of investors piled in at the peak, thinking it would hit $1. But within months, it crashed back down, wiping out millions in investments. Bitcoin is the most well-known cryptocurrency, but there are thousands of other coins and tokens out there known as altcoins. Some of these altcoins promise innovative new features or technologies, but many of them turn out to be nothing more than speculative investments with little to no real value. Altcoins often experience wild price swings, driven by speculation rather than real-world utility. A coin can skyrocket overnight, then disappear within a year. Most of the altcoins from 2017's bull run don't even exist today, and the same will likely happen again. One of the biggest reasons why so many people lose money in crypto is because they don't fully understand the market. Many new buyers jump in without understanding the risks involved. Crypto is a highly complex and technical space. Without a solid understanding of how it works, it's easy to make mistakes. Many people fail to realize that crypto is not a get-rich-quick scheme, but rather a long-term investment that requires careful planning, risk management, and understanding of the market. Another problem that many crypto buyers face is overconfidence. After seeing some early success, people think they've figured it out and can make money with ease. They might start taking bigger risks, buying into more speculative altcoins, or ignoring important warning signs that they would have noticed if they weren't so overconfident. On top of that, many people rely on advice from online influencers or friends rather than doing their own research. These sources may not always have the best interests of their followers at heart, and they can lead people down the wrong path. This overconfidence and reliance on misleading advice can end up costing investors a lot of money. Let's talk about one of the biggest scams in crypto: pump and dump schemes. Here's how it works. A group of insiders artificially inflates a coin's price, the pump, getting everyday investors excited. Then, once the price is high enough, the insiders sell off their holdings, the dump, leaving regular investors with worthless assets. These schemes are often orchestrated in private groups on Reddit, Telegram, and Discord. By the time the average investor realizes what's happening, it's already too late. One major example was the infamous Save the Kids token, where influencers promoted a crypto project that later turned out to be a scam. The price was pumped up and early insiders cashed out, leaving everyday investors with nothing. Crypto operates in a legal gray area. Unlike stocks, which have SEC protections, crypto has very few investor safeguards. This means scams run rampant. Fake initial coin offerings, ICOs, fraudulent exchanges, and Ponzi schemes have stolen billions from investors. And because the market is still evolving, there's little recourse for victims. Regulation is coming, but for now, it's still the Wild West. And until the rules are clearer, crypto remains an incredibly high-risk investment. Despite its massive growth, crypto is still a developing market. It faces challenges like security vulnerabilities, regulatory uncertainty, and adoption barriers. The reality, many current projects won't survive. Some coins will disappear entirely, others will adapt, but picking winners is nearly impossible. Crypto has potential, but for most people, it's not the gold mine it appears to be. The market is volatile, unregulated, and filled with risks. If you're thinking about investing, remember, crypto isn't a shortcut to wealth. It requires research, patience, and strict risk management. Never invest more than you can afford to lose. Because in this market, the odds are stacked against you. So why do 99% of crypto buyers lose money? Now you know. Smart investing isn't about chasing hype. It's about discipline and strategy. If you found this helpful, make sure to like, subscribe, and let me know your thoughts in the comments.